We got to wonder what the rest of the year looks like for China markets here. You're bringing down your cash levels. You're putting money to work. What gives you confidence that we could see a year-end rally now?
I think the four concerns that the market had for China, on the margin, they're turning for the better. We've been pretty early in calling the reopen trade last year, but we turned a bit more sort of cautious and calling for a sideway through February and particularly May onward. And so end of last week was when we turned more bullish on this tactical year-end rally. I think it goes back to the four main risks that people are worried about China: geopolitics, growth slowdown, both short-term tactical growth and long-term structural growth post-exiting a major asset price peak. And then related to that, regulation, what companies do in balancing their revenue vis-a-vis growth. And I think on all four, we're seeing a bit of a marginal improvement that is not being priced into the market. And then finally, the dollar has given a bit of a window for a little bit of a weakness, owing to what is coming up in the U.S. macro data vis-a-vis rest of the world. I think it's generally good for EM markets if we have a slightly weaker bias in the dollar on a tactical basis.
Okay, you're seeing marginal improvement, I guess, when it comes to the policy front and the like. I'm just wondering, what does this rally look like to you then? Is it double-digit sort of gains that we're expecting? And would that be a bullish signal to you?
Yep. So we call for a range-bound market on MSCI China from 54 to 66 through most of the year, and we think there is a potential for it to go back to 66. So you are looking at close to 15% growth upside. So it is substantial. And I think on geopolitics, you'll get some confirmation at the APEC next week on marginal growth, tactical growth that we have already got from the extra stimulus from late October. And so at JPMorgan, our first half GDP growth has been revised up for China. And then on regulation has softened in terms of return on investment and entrepreneurs, but it takes some time for the market to adapt. And then finally, we're seeing selected signs of price hikes and then less willingness to fund excess capacity expansion. So this capacity expansion led excessive price cut hurting return on investment. We're seeing a little bit of improvement. So that's where we're coming from.
Okay, how do the external factors play out, right? If the Fed is perhaps close to ending this tightening cycle, Wendy, I'm just wondering how beneficial is that to Chinese markets, and in particular, what are your assumptions of the U.S. dollar moving forward too, and how that impact, the China market?
Yeah. So at JPMorgan, our view on the U.S. dollar is that it's perhaps moving from a U.S. exceptionalism to U.S. being better than the rest. So it is still resilient, but there are windows where it could have a little bit of a soft patch. So if you look at last year's reopen rally, part of it was because dollar index turned a bit weaker. So dollar is still very strong in the sense that it has the most sought-after asset for investment dollars. So that is unchanged. But if the dollar has a weaker patch, then it is an upside risk to EM assets, and China is included in the broader part of the EM equity assets.
Yeah, and in terms of your cash levels, kind of close to 9% to now 1%. What have you really done in terms of sector allocation now in the last few months? What's going to be something that you think can really outperform for the rest of the year? And what do you think? What are you trimming to?
Yeah. So that was a position we made changes for in mid-June. We raised defensive, we raised cash, and at end October, where we put that to work are three notable overweights. One is for consumer durables and brands. So we do like sportswear, we like branded dairy, beer. Consumer is a recurring business, and the valuation has come down a lot. The other thing we like is consumer services. So there's Macau, after-school education. That has also been resilient and improving. And then finally, capital goods, replacement demand, exports, and beneficiary for infra, renewable, and EV. We see different single stocks that fit in our model portfolio. Where we are underweight is really this general property ecosystem, because as the exit continues and the rationalization of capacity continues, there will be an impact on the broader ecosystem, particularly related to the building materials and then to the financials. So where we are underweight are banks and materials pertaining to the property sector, and then we use transport, a lower beta sector, to the current growth as a funding source. So that's how we're lined up on the model portfolio.